Are you ready to take your hard-earned money and watch it grow with minimal effort? Imagine turning $10,000 into a steady stream of passive income. Sounds like a dream, right? Well, it's not just a fantasy, it's possible with the power of dividend investing. In this video, we'll uncover the truth behind dividend investing, how you can leverage it to build wealth, and exactly how to turn $10,000 into a sustainable passive income source. Stick around, because what you learn here could change your financial future. Before we dive into how to turn $10,000 into passive income, let's quickly talk about what dividend investing really is. Dividend investing is a strategy where you invest in stocks that pay you a portion of the company's earnings called dividends on a regular basis. These payments usually come quarterly, and they can provide a steady, reliable source of income. The beauty of dividend investing is that it allows you to make money without having to sell any of your stocks. You're simply collecting dividends while your investment continues to grow. It's like getting paid to own shares of a company. Now, you may be wondering, why should you choose dividend investing as a strategy for generating passive income? Well, there are several key reasons. 1. Steady cash flow. Dividend-paying stocks offer a predictable income stream, which is perfect for anyone looking for consistent cash flow. This is especially important if you're retired or want to supplement your regular income without constantly working for it. 2. Compound growth. By reinvesting your dividends, you can take advantage of compound growth. The more dividends you reinvest, the larger your position in the stock becomes. This snowball effect means your passive income grows faster over time. 3. Lower risk. Dividend-paying companies are usually well established and financially stable. They've been around for a while, and their profitability has allowed them to pay dividends consistently. This stability makes them less volatile compared to growth stocks that don't pay dividends. 4. Tax advantages. In some countries, dividends are taxed at a lower rate than regular income, which means more money stays in your pocket. Now that you understand what dividend investing is and why it's a powerful tool for passive income, let's get into the specifics. Let's say you have $10,000 to invest. With this amount, you can start building a portfolio of dividend stocks that will pay you regularly. But how exactly does this work? The first step is to find dividend-paying stocks with strong, reliable dividend histories. These are companies that have paid and increased their dividends over time. When you buy shares of these companies, you'll receive dividends on a regular basis. For instance, let's take a company like Coca-Cola Co. Coca-Cola is a well-established dividend stock, known for paying regular dividends to its shareholders. If you invest $10,000 in Coca-Cola, you'd receive regular dividend payments, say 3% annually. Quick math. With a 3% dividend yield, a $10,000 investment would earn you $300 in dividends per year. That's passive income you didn't have to work for. So, how do you pick the best dividend stocks for your $10,000 investment? There are a few key factors to consider. 1. Dividend yield. The dividend yield is the percentage return you'll get from your investment in dividends. A higher yield can be attractive, but you have to make sure the company can sustain that payout. Too high of a yield may be a sign of an unstable company. 2. Dividend growth. Look for companies that consistently increase their dividends over time. Companies with a track record of increasing dividends year after year tend to be more stable and trustworthy. These companies often prioritize their shareholders and have a solid financial foundation. 3. Payout ratio. The payout ratio is the percentage of earnings a company pays out in dividends. A sustainable payout ratio is generally between 40% and 60%. If a company pays out too much of its earnings, it may struggle to maintain those dividends in the future. 4. Financial stability. Ensure the company has strong financials. You want to invest in companies that have a history of profitability and aren't at risk of cutting their dividends. 5. Diversification. Don't put all your eggs in one basket. Spread your $10,000 across a variety of stocks in different sectors to reduce risk. For example, you could invest in utilities, consumer staples, and healthcare, all of which tend to be stable, dividend-paying sectors. One of the most powerful ways to accelerate your passive income is through dividend reinvestment. Most brokerage accounts offer a dividend reinvestment plan DRIP, which automatically reinvests your dividends to buy more shares of the stock. This is where the magic of compound growth comes in. By reinvesting your dividends, you're essentially buying more shares without having to put in any extra money. Over time, this can significantly increase the number of shares you own. And as those shares continue to pay dividends, your passive income grows even faster. Let's break this down with a real-life example. Let's say you invest your $10,000 into a diversified portfolio of dividend-paying stocks. Here's a hypothetical scenario. Company A Coca-Cola, $3,000 investment. 3% yield equals $90 in annual dividends. Company B Johnson & Johnson, $3,000 investment. 2.5% yield equals $75 in annual dividends. Company C Procter & Gamble, $2,000 investment. 2.7% yield equals $54 in annual dividends. Company D T, $2,000 investment. 7% yield equals $140 in annual dividends. Total annual dividends, $90 plus $75 plus $54 plus $140 equals $359 per year. Now, if you were to reinvest your dividends using DRIP, that $359 would be used to buy more shares, which means you'll earn even more dividends in the following year. Over time, you can see how this strategy helps your passive income grow. If you keep reinvesting, in 5 years, your annual dividends could easily exceed $500, and by year 10, they could be close to $1,000 annually. Once you've invested your $10,000 in dividend stocks, it's important to manage your portfolio. Here are some tips to keep things running smoothly. 1. Monitor your dividend stocks regularly. While dividend investing is a long-term strategy, it's important to keep an eye on your investments. Make sure the companies are still paying reliable dividends and that their financials remain strong. 2. Balance your portfolio. As your portfolio grows, you may want to rebalance it periodically. This means adjusting your investments to maintain your target allocation across different stocks and sectors. 3. Stay informed about tax implications. Remember, dividends are taxable. Depending on your country's tax laws, you might owe taxes on the dividends you receive. Stay informed and consult with a tax professional to make sure you're minimizing your tax burden. While turning $10,000 into passive income is achievable, the real benefit of dividend investing comes with time. As you continue to reinvest your dividends and grow your portfolio, you'll see exponential growth in your passive income. Imagine, after 20 or 30 years, your $10,000 investment could have turned into a significantly larger portfolio, generating thousands of dollars in dividends each year. Compounding over time is the real secret to building long-term wealth. The more time you give your investments, the more dividends they'll generate. This is why starting as early as possible is crucial. Of course, no investment strategy is without risk. While dividend investing is relatively low risk compared to other strategies, it's important to understand the potential downsides. 1. Dividend cuts. If a company faces financial trouble, it may cut its dividend payments. Make sure to choose companies with solid financial health and a history of increasing dividends. 2. Market volatility. The stock market can be volatile, and while dividend stocks tend to be more stable, they are not immune to market crashes. It's important to stay diversified and avoid panic selling. 3. Inflation. Over time, inflation can erode the purchasing power of your dividends. To combat this, Focus on companies that have a track record of increasing their dividends at or above inflation rates. Turning $10,000 into passive income through dividend investing is a powerful strategy. By carefully selecting reliable dividend stocks, reinvesting your dividends, and staying patient, you can build a sustainable income stream that grows over time. If you found this discussion intriguing, I highly recommend you check out my previous video titled Exposed: The Truth About Average Net Worth by Age. Prepare to be surprised, where we delve into some shocking financial realities based on age demographic. Understanding net worth distributions is vital for setting realistic financial goals and recognizing your potential growth trajectory. And if you haven't already, don't forget to subscribe to my channel for more tips on how to make your money work for you. Hit the like button and drop a comment if you have any questions about dividend investing. Thanks for watching, and let's build wealth together.